Welcome to lecture 24 of financial management. We are continuing our discussion on this topic of cost of capital. In this lecture, we are going to cover the aspect of cost of equity. How do we find cost of equity? Remember, in previous video, we discussed what cost of equity is, what cost of capital is. Then within cost of capital, we have cost of equity and cost of debt. So in this video, we are going to explore how to find cost of equity, how to calculate cost of equity. And for that, we are going to use two different models. First is the dividend discount model, and the second one is the CAPM or capital asset pricing model. So starting with cost of equity, we know cost of equity is the cost of acquiring the equity, and we need this aspect to find weighted average cost of capital. For that, we can use two different models. The first model is dividend discount model, and this model had been discussed in a stock valuation chapter. In previous videos, we have where we have discussed stock valuation, we have in depth explored the idea of dividend discount model. And then there is a second model which is called capital asset pricing model, or CAPM for short. So we are going to use these two models to find to estimate the cost of equity. So starting with the first one, dividend discount model. Remember, dividend discount model assumes that the share price would depend on the future dividend. So what we do is we find the present value of all the future dividends, and that would become the intrinsic value of a stock. So intrinsic value of a stock depends on the future dividends. And within that dividend discount model, we had three models. First one was non-constant, no growth model. The second one was constant growth model. And the third one was non-constant growth model. Okay, so basically when we refer to this constant growth model, we also call it Gordon growth model, or we call it dividend growth model. So specifically we are going to use this model, the second model, to estimate the cost of equity. So if you remember, the formula for calculating the intrinsic value of a stock in the stock valuation chapter was P naught is equal to D naught into 1 plus G. G stands for growth, D stands for previous dividend, divided by RE. RE stands for cost of equity. This E denotes the equity. Minus again the growth rate. This formula we have already discussed, or in short we write it in this form: D1 divided by RE, again, which is cost of equity minus the growth rate, and D1 is equal to D naught into 1 plus G raised to power 1. Okay, this is what we already know. But what we can do is we can convert this formula. If we are given D1, we are given G, we are given P naught, what we can do is we can convert this formula to find this unknown. So if we convert this formula, which is P naught is equal to D1 divided by RA minus G, into this form by arithmetically, so we would have this formula, which would be cost of equity is equal to D1 divided by P naught plus G. So if you are wondering how this had happened, then let me simplify it. If we multiply, if we transfer this part on the left side of the equation, then it would be RE minus G into P naught is equal to D1 if we simplify it, we transfer this P naught over here, then it would be D1 divided by P naught, and we would remove it from here, and then we would have RE minus G divided is equal to D1 by P naught. If we transfer this G over here, then it would become positive G. So now our formula would be RE divided is equal to D1 divided by P naught plus G. This is what I have written here. So what we have essentially done is we have used the dividend growth model formula, the same formula that we have already understood, and we have converted it to find this missing value of cost of equity. So where D1 stands for expected dividend, the next year dividend, the next time period dividend, the P naught is the current price, and G stands for the growth rate. So let's have an example, and this would give us a clear idea. Let's say there is a stock, there is a share of Lucky Cement which is traded at 60 rupees per share. By the way, nowadays it is around 600 rupees. So if Lucky Cement stock is at 60 rupees per share, if the firm paid a dividend of 3 rupees last year, and the estimated growth rate in dividend is 5%, then estimate the cost of common equity. Remember, whenever we say equity, then we are simply referring to common equity, although equity consists of both the preferred stock and the common stock. But for this lecture, we are the word equity, we are using it for common equity. So to find common equity, what we need to find essentially is RE, and we know we need to use, the question asks us to find the cost of equity using dividend growth model. So what we need to do is we need to use RE is equal to D1 divided by P naught plus G, the formula we have discovered in previous slide. We have developed in previous slide. But in this case, the P naught is 60. How do we know? Last trading value is 60. We know G, which is 0.05 or 5%. But what is D1? We do not know D1 because D1 is the expected dividend, the dividend of the next time period. But in this example, we had only been given the dividend of last year. So you know this is not D1, rather it is D naught. 3 is D naught. But we know D1 is equal to D naught into 1 plus G raised to power 1. So what we can do is we can use this 3 into 1 plus 0.05 raised to power 1, and this would give us the D1. So what we are going to do is we are going to find D1 using the value of D naught. So this would be equal to 3.15. So now we have the value 3.15. What we can do is use this equation to find the cost of. So the answer is 0.1025 or 10.25%. So what this means is this 10.25%. How do we interpret it? This value is that the cost of equity, the cost of acquiring common stock, right, for Lucky Cement is 10.2%. So if they are going to start a factory and they need funds, and if they are going to acquire those funds from common equity, that is by issuing common shares, common stocks, then their cost for that purpose would be 10.25. Okay, and in future lectures, we are going to see some more examples on this, and that would further clear our concepts. But for now, we know that this value is the traded value. We can get this value from the stock exchange website's data. This is the last trading value. We know last dividend, it would be in balance sheets or the financial statements. But how do we get this growth value? So what we can do is we can estimate the growth using two methods. First one is either we can use the historical growth rates, and what does it mean is, let's say we want to find a G. We do not know what G is for Lucky Cement, but we know that in 2005 the Lucky Cement offered a dividend of 1.1. In 2006 the Lucky Cement offered a dividend of 1.2 to its shareholders. In 2007 it was 1.3, in 2008 it was 1.4, and 9 it was 1.55. So what we can do is we can find the growth here. And how do we find growth here? It is current. So it would be current value minus the previous value, this whole divided by previous value. So it would give us some percentage. We would do that process again here, 1.35 minus previous value divided by previous value. It would again give us some percentage. We are going to repeat this process and we are going to get all the percentages, and once we average those percentages out, then we have the growth rate. So what essentially it means is that if dividend had grown at say percentage A from 2005 to 2006, and from 2006 to 2007 it is grown at percentage B, then we can take the average of this A and B and we would have this growth rate. The second method is, by the way, the previous example is solved here. So this would be, dollar change would be 1.2 minus 1.1 would be 0.10. This example is in your book also, in corporate finance book. 1.35 minus 1.20, it would be 0.5. If we divide it by 1.10, this one by 1.20 previous values, this one by 1.35, and this one by 1.55, then we get these percentages, right? If we average them out, then we would have a growth. So one method is this one. We take the historical averages of the growth rate. The second method is we use the analyst forecast of future growth. That is, there are different analysts, brokerage firms, analyst firms. They give their forecast that what would be the growth of this specific stock or the dividend in next quarter or next year. So what we can do is, rather than calculating our own growth rates, we can take the growth rates from those analyst forecasts, right? So by the way, these are the two methods that we can use to find the growth rate. There are some disadvantages of dividend discount models. The first one is that it is only applicable to firms that pay dividend, right? Remember, we also discussed this idea that dividend discount model is limited in the sense that it can only be used for the companies that pay dividend. Again, if it is growth model, then there must be constant growth in the dividend. It can only be used for the firms where there is a constant growth in the dividend. It is sensitive to the value of G. What this means is that if we take the value of G as at 6%, then our cost would turn out to be 13.06. How is that so? We first need to find value of D1. It would be D0 into 1 plus G. If D0 is 4, last dividend is 4 rupees, and G is 6%, then the D1 would be 4.24. If we input that into the cost of equity formula, then 4.24 divided by 60, remember in previous example we had the value of 60, plus the growth rate, the cost of equity is 13.06. But if we just increase 1 percentage point, rather than taking 6%, we estimate that our growth rate is 7%. Remember, growth is, in real life, it is estimated growth rate. So instead of estimating that the growth rate would be 6%, if we estimated that the growth rate would be 7%, then what would happen? Then our 4 into 1.07, this new growth rate, our dividend would be 4.24. Again, we apply the formula, it turns out to be 14%. Now you would see that there is a huge shift in the cost of equity. By only changing 1 percentage point, our cost of equity increases by 1%. So this is one disadvantage, that this dividend discount model is sensitive to the value of G. If we wrongly estimated the value of G, then overestimated it, then our cost of equity would be overestimated. If we underestimated the value of G, then our cost of equity would be underestimated. And lastly, which is the important point, and this point is catered into the second model of CAPM model, the capital asset pricing model. This dividend discount model do not take the risk factor into account. I mean, there is no risk factor in this whole dividend discount model. So what we do is, because of these disadvantages, and specifically the disadvantage of dividend, the constant dividend and the risk factor, what we do is we have another model which is called capital asset pricing model, CAPM. This model was presented by William Sharpe, and basically this was his thesis, his PhD thesis. He completed his PhD thesis in 1960s or 61, and then it was published in 1964 in the Journal of Finance. And this was a groundbreaking model. Before that, we didn't had any good model to find the cost of equity or the required rate of return. So this model looks like this. The required rate of return or cost of equity again is equal to risk-free rate plus the beta, which stands for systematic risk, into RM minus RF. This RE stands for cost of equity, RF stands for risk-free rate, and RM stands for market return. So what William Sharpe did, he said that the return of a stock, remember equity cost is from company's point, but return is from investor point. So the question is that why some stocks have higher return, the other stocks have lower return. Again, I'm just giving you a broader picture of this CAPM model. You are going to further explore this CAPM model in the corporate finance and the investment subject, the investment and portfolio management subject. So this required rate of return, why some companies have a higher return, the others have a lower return, William Sharpe presented that it depends on the systematic risk. If the systematic risk of a company is higher, it would have a higher return, it should expect a higher return, its required rate of return would be higher, its cost of equity would be higher. If the systematic risk of a company is lower, its cost of equity would be lower. By the way, systematic risk, we divide risk into two parts. One is systematic risk and the other is unsystematic risk. The unsystematic risk is the risk that is just particular to a firm. It would just affect a single firm. And the systematic risk is the risk that would affect a lot of firms, more number of firms, or the whole market, or the whole system. So that's why we call it systematic risks. For example, the risk of earthquake, the risk of inflation, increase in inflation, the risk of change in interest rate, the risk of war. When war happens, when flood happens, when earthquake happens, when the economy is in downtrend, there is a recession. All these risks would not just affect one firm, it would affect whole economy, more number of firms. So for example, the risk of a virus, COVID virus. This virus would not affect just single firm, it would affect whole economy. The business would stop all of a sudden. So it is a systematic risk because it affects the whole system. But if there was a risk that would just affect a single company, for example, a risk of a fire in a factory, in a warehouse. So this fire in a warehouse would just affect that specific company. So if there is a fire in the warehouse of a Lucky Cement, that would just affect the Lucky Cement profitability, right? So it is unsystematic risk in a sense that it would just affect single firm. So William Sharpe presented that there is no return for some reasons, diversification reasons, but let's not discuss that. For some reasons, investor would only earn return for systematic risk. So if a firm have a higher systematic risk, If a firm is affected highly by some systematic risk, say inflation, then that firm should pay higher, that firm investor should demand higher return, because the higher the risk, the higher the return. If that firm's investor would demand higher return, then its cost, that firm's cost would also be higher. So based on this logic, this is our model. We are going to find the cost of equity using the CAPM model in next video.